All right. Well, good evening, everybody. Welcome to our Q1 client networking event. Obviously, I think we're all sitting behind computer screens, probably getting fatigued at this point. But this is what we're calling the new normal, and this is really kind of what life is going to look like, at least for what appears to be the short term. And possibly longer than that. So for those that don't know who I am, Jason DeBono, Vice President, NuView Trust Company. I've been here for a little over 15 years, and I'm so excited about today because Kevin is going to talk to us and share with us some insights on private lending, which is incredibly near and dear to my heart. That was the first investment I ever made inside my self-directed account, and I've done about 15 different notes of a variety of different ways, but all note investments. And I think it's something that is a very interesting topic as we really look at what's going on in the marketplace around us. So normally for our quarterly events, they're more networking based, and it's really an opportunity for you guys to not only hear a little bit about the state of NuView and how we see and what we see in the self-directed community, but it's also a chance to hear from some sort of industry expert, somebody that we've found in the marketplace that we believe does a great job of sharing good quality content. As we disclaim on every presentation we do with any third party, we don't pick them because we recommend, endorse, or approve them. We pick them because we believe they give good quality bits of information and stuff that you can take and utilize in your due diligence and decision-making process. And then obviously the networking. And that's the thing that we've got to go without today. So we're going to have to work extra hard, Kevin, to make sure that we deliver enough content that makes up for that lack of networking time. And I think we're all going to have to get used to not a whole lot of networking for quite some time. But where do we stand? Where is the market? What's going on? And I think the only word that sums it all up for now is crazy. It's an interesting couple of months. I think if you'd asked most people 2 months ago when there started to be kind of some rumblings about this virus going on in China and what is it and what's it mean, I think very few people would have saw what's coming today. Even if you go back just 30 days or 25 days, if you'd have thought that we were going to be in an environment where restaurants were shut down and cities and states across the country had, stay-at-home mandates or ordinances in place, I think we'd all, probably think, well, that seems a little bit too crazy to actually become reality. And so here we all are living a little bit in this movie, if you will. But what does it mean for us as we look at this as an opportunity, and what does it mean for us from an investment? Now, certainly I am not a financial advisor. I'm not an expert by any stretch of the imagination. But having lived in the self-directed IRA space for the last 15 years, I've been fortunate to meet a lot of great people, a lot of smart people, and I've been fortunate to see a lot of different and unique investment strategies. I've also seen a market rise quickly in 05 and 06, and I've seen it fall quickly in 07, 8, and so on. So I don't quite know where to even begin talking about what we're seeing in the marketplace today, but it's a very interesting one. I think what happens in a lot of times like this is we face a few different phases, right? And I think the first phase is what's actually going on around us. Now, this is an interesting time because unlike in the Great Recession of 2008 and beyond, we have this medical underlying kind of health issue that we're battling on top of what we're starting to see that we know will have some sort of impact on the economy. How big, how small, nobody knows. But it's very unprecedented that you have both potential financial risk, and we saw that with an over 20% drop in the stock market, right? And then you also have that by just simply looking around at all the businesses that have been completely displaced and shut out. And so you have people that are not working, and we all understand it doesn't take an economics degree to know that if people aren't at work, people aren't spending money. If people aren't spending money, people aren't making money. If people aren't making money, the economy's not growing, right? And so we know there's some sort of natural deterioration that occurs. The question is how much, how long, right? And we're all going to have to be Monday morning quarterbacks a little bit on that. But I want to share a couple of things, and I want to share a story, if that's okay, because I amidst all of this that's going on, I've talked to a lot of different people, and I've heard a lot of different opinions on the market. And so I've kind of taken what I think a lot of people have thrown out there. And I went to the barber shop last week to get a haircut. Thankfully, they were still open. But what's interesting is this is a barbershop that's normally very busy, and I was the only person in there. There were 3 barbers and me. And I felt almost like, I was getting this royal special treatment at first. I got to go right in. All of them were kind of standing there. And I asked, how are you guys doing? How's this whole, kind of shutdown, if you will, of society impacting you? And the first guy said, I'm just looking for the right stock to buy. And I thought, well, that's an interesting comment, given all that's going on. I said, well, tell me about it. What do you mean? He said, oh, man, there's just so many deals in the stock market. I said, okay, why do you say that? He said, well, because it's down. And I said, oh, awesome. I said, so do you believe that if it goes down, it goes back up? And he said, of course. I said, how long does that take? And he paused, and the other guy kind of chuckled, and the guys were all kind of talking, and they're like, I don't know. And I said, neither do I. I'm not asking the question because I know the answer, but I'm curious if you're ready to go buy, what you think makes today versus tomorrow versus the next day a good buy. And in that discussion, we talked quite a bit, and they said, well, what's your opinion? And I said, well, first of all, lots of people have lots of opinions. I promise you, mine's no better than anyone else that sits in this chair and tells you. But I do think it's interesting because if you really look at the way that the talking heads and pundits talk about the market, what does everyone tell you to do when you're invested in the stock market? It goes down. Wait, right? Just hold everything and wait. And I don't subscribe to that philosophy personally. I don't own a lot of stocks. I've never been much of a fan of the stock market, but I sold every single security that I own. And I did that probably not at the best time, but I salvaged a much bigger drop. And people ask, so when are you going to go buy? I don't know. Here's the problem. So I said to these guys, I said, well, let me ask you a question. If you were to buy a stock today, whatever it may be, and whatever discount you think you would buy it at, do you think you're timing the market well? And they said, yeah. And I said, okay, well, how do you know when you time it right on the top end? So what do you mean? I said, if the market goes up 10% tomorrow, are you going to sell? Well, I said, what if it goes up 2%? What if it goes down 5%? The problem with trying to time any investment market is people think that they can time it on the way down, so naturally they can time it on the way up, and it just doesn't work that way. I'm a big believer in long investing, unless you understand the type of investing you're doing. So the question I asked him was, if you were going to get on an airplane with me today and we were going to fly to Vegas and we were going to go gambling for the weekend, how much money would you bring? $1, $5, $5,000, $500,000? How much money would you bring? Because that's the amount of money that you should be putting into the market right now if you're trying to time it on the way down and the way up. Because that's money that you're prepared to lose. It's gambling money. And there's nothing wrong with that. That's high risk, high reward. But if you're not prepared to put that money in there and ride this out, which could be 2 weeks, and you could make good money, it could be 2 months, it could be 2 years. But remember, we're on an 11-year market run. So if you were to invest your money, right, looking back in 2009, 10, 11, 12, 13, chances are your return as a percentage is no different. So when you really step back and look at it, timing the market, I don't want to say is a failing prophecy or fool's gold, but you have to understand it likely is. So if you're out there trying to figure out what market makes sense and deals are going to happen, I agree with you 100%. In fact, our business as a custodian of self-directed accounts got busier in 8, 9, 10, 11 because more deals became open and more people tackled them. But if you think that your investment philosophy is going to be buy when everything's low and sell when everything's high, that's a really tough thing to time. So I love notes personally, and I'm so glad Kevin's talking about it because I think the timing of it couldn't be better. Generally, notes is a long game. It's not a get-rich-quick scheme. If you're looking to go out and self-direct, or you're currently self-directing, you're looking to build wealth, it's not done overnight, right? Don't let anything you read on the internet suggest that's the way to do it. It's done over the good long haul. So here at NuView, obviously amidst all of this, we're here, we're fully open for business, we're servicing our customers. We are an essential business. About 95% of our staff has continued to come in. We have all the necessary precautions that we possibly can take, as we go through this, but we're all navigating this storm a little bit together. So as I kind of wrap up and turn this over to Kevin, I think I just would share a few things for you. Number one, doing nothing is making a decision, right? Doing nothing is actually making a decision. So some people in times like this say, I'm just going to do nothing. Okay, well, that's okay. Just understand that's a decision. Number two, there is no such thing as a bungee cord investment, right? Meaning as quickly as it goes down is as quickly as it goes up. There may be a few examples of those, but those are exceptions, not rules. Just remember that, right? A couple other things to keep in mind. If an investment goes down 30%, right, and it goes up 10%, you didn't get back 10 of the 30, right? Because 10% it went up 10% on a much smaller number and went down 30% on a much bigger number. So don't be misled when you see these numbers and think, well, the market's coming back. And this isn't just the stock market, it's any market. But remember, percentages coming up have to be significantly higher to match percentages going down because you're dealing with much smaller numbers. The last thing that I want to give, and I talked so much about this in 2009 and 10, 11. Always remember, right? Every time you get in your car is the same way you should think about how you invest. The windshield is really big and the rear view mirror is really small, right? And if you drive, you don't drive by staring into the rear view mirror. That's a problem. You get into an accident, but you glance in there to remind yourself what's behind you. But we drive through the windshield. And my advice to everybody is drive through the windshield through this. Look out, the windshield's big, look around. There's going to be lots of opportunity that lies ahead of us. But if you drive too much staring out the rear view window going, man, that investment was worth 20% more, 50% more. I should have sold it. I should have done this. You can't make those decisions. Learn from them. Let them guide you and remind you on how to better drive going forward. But don't look in the rear view mirror too much. Keep looking out that windshield. We certainly wish you guys all the best through your investments. We're going to go through today or tonight. Kevin is going to walk through some of the great information on note investing. He's 1,000 times more knowledgeable about that subject than I am, so I'm super excited to hear him talk through it. We will take Q&A at the end. There's two ways that you can engage in Q&A. There's a chat function. You can type your questions in. There's also a Q&A button. You can type them in there as well. Either way is going to work for us. We will read through those and answer those aloud for the entire audience as we wrap up. So Kevin's going to go about 30 minutes or so and talk to you guys about notes and how they work, and we're happy to take your questions at the end. So Kevin, you good? You ready to rock?
I'm ready to go.
Awesome. Well, Kevin, I'm going to turn it over to you, and we'll be back here in a few for Q&A.
Sounds fantastic. Great. Thanks everybody for being here. It's a privilege to do this for you. I love this topic, love talking about it. And I'm going to do my best to give you as much information as I possibly can in the 30 to 40 minutes, let's call it, of information that I can give to you here. But to echo some of the things that Jason was talking about, it is interesting. The original name of this, I believe, or the name currently is Spring into Retirement. And boy, a lot of people took a big hit on that retirement with the stock market. And if anything, that shows us that diversification is so important. And in the industry that I've been a specialist in for a long time, which is the real estate and real estate note industry, it's a great place to diversify your investments. I've never been one of those people that says do notes and do notes only. I think a proper diversification makes complete sense for everybody to look at. But it's been interesting over the years that I've been in this industry to see it go from a niche, and that's what real estate notes has traditionally been, at least when I got started, now into recognized as its own asset class. And I think that's important for you all to know. Notes isn't considered a niche anymore. It's a massively big business. It's widely recognized now and talked about on a regular basis amongst investors at all levels. So it is something that you should consider at a minimum. And in today's world and moving into the future, one of the things I'm going to talk about tonight with you is the market, where it's going, what's likely to happen in the marketplace. And I'm going to give you some beginning information, some beginning knowledge, and also some advanced techniques, but also show some of you who have been around and possibly even have invested in notes already, to show you some of the new things that have come along in the note business. So what I'm talking about tonight will apply literally to everybody on this call, because you no longer have to be accredited. You no longer have to have high balances to be in this industry. And that's how I'll approach this with you. So many of you are probably familiar with me if you go to the NuView events like P4P. That was last year and such. I was there. I may have met some of you there. But my background's in real estate and real estate notes. As I said, I got started actually almost 30 years ago now in the note business, and got involved in real estate as well. So my career has been on both sides of the real estate coin, if you will. And I got back into notes really on a full-time basis about 10 years ago, and been there ever since, because today really the marketplace is blending the best of real estate notes with the best of more traditional real estate. And I've gone on, as you can see on your screen there, I have a podcast you're welcome to subscribe to. I'm still very heavily involved as an educator in the business. In fact, I've probably trained more people in the note business over the last 10 years than anybody, through 3-day trainings and online trainings such as this. And I wrote a book a year and a half ago, Real Estate Without Renters, and that became a #1 bestseller in actually 4 different categories. So I'm telling you that just to let you know about the background of the person that you're listening to, widely recognized. There's more information if you want to look me up or anything like that. I'm not going to obviously go through all of this information with you, but been media author, professional speaker, and have been in and around the real estate note business for a long time. So what I want to make a case for initially in the presentation with you tonight is, why notes? And that should be one of your first questions, right? If you have capital that you're looking to invest for retirement with these tax sheltered accounts, why should you consider notes? You have a lot of alternatives, right? Especially at NuView, where you can self-direct everything, and as long as it's allowable investment, you can do it, right? So if you want to get into investing in gold and stocks and mutual funds and real estate, rental properties, whatever you want to do, absolutely you can do that. I want you to think in terms of why notes. So I want to make a compelling case to all of you as why you should consider notes as a part of your investment portfolio. I'm going to start with a couple of bullet points here. The first one is, notes purchased correctly can be low risk and high yield. In fact, there's a rather unique thing in the note business where it breaks most of the laws that we have been taught when it comes to investing. And the one law in particular is, most investors have always heard high risk, high reward, low risk, low reward, which makes a heck of a lot of sense, right? If you want to have a nice, safe investment right now, where could you put it? Well, it's not quite as safe as it used to be. You could buy T-bonds. I just read today that they're actually 3-year T-bonds are paying negative percentage. But let's say you get a 10-year, you're making 0% on your money there. Low risk, but you're getting a low reward. If you bumped it into a CD, maybe you make a 1% on that. Or you could invest in Bitcoin. You could invest in the stock market. And yes, you might make a high yield, but you're also taking on high risk. In the note business, you can actually take a lower risk and get a higher yield. And it has everything to do with leveraging, but not leveraging to borrow money. Okay, there are companies, there are individuals, there are investors that leverage to borrow money. That's not what I'm talking about here. So I'm going to explain more about that as we go through. But the biggest reason for that, of course, is that in the note business, we're buying a secured investment. Our investment is secured by the property itself, whatever that real estate is. And that could be vacant land. It could be an apartment complex. It could be a single family home. It could be an office building or warehouse. It can be any type of real estate, and that's our security. So knowing that we have security to back our investments, we can lower our risk by paying less for that investment. I hope that makes sense to everybody. If we have something, and I'll just say something in general, that's worth $100,000, and you can invest $50,000, and if the investment isn't being paid properly, you end up getting that asset that's worth $100,000. I think everybody listening would agree that that's a safer investment. You know, it's backed by something of higher value. And that's the key in this business. Everything I talk about here, everything I talk about on everything that I do in teaching in this business, we look at risk first, then reward. Risk first, and then reward. The security of the real estate is first and foremost. Then it's just a matter of how much we have in that. Now, there's many other reasons for notes. I'm going to focus on those two key items here. We'll talk a little bit about the third bullet point here, which is active or passive. Many investors, especially when it comes to your retirement accounts, which is the bulk of this audience, right? When it comes to retirement accounts, I think most people are looking for a more passive investment. They want to have their money work for them. Great. The note business can deliver on that. But we also have other more aggressive people with retirement money that need to make higher returns. They're maybe younger. They want to be more aggressive when they're younger. Whatever it is, they want to be more active, and they might be buying real estate and flipping property and things like that. The note business can deliver there too. So whether you're active or passive, the note business can deliver. It can deliver a lot of different things, some of which I'll expose to you on this call. The fourth bullet point I wanted to bring out to everybody, and this echoes along with what Jason was saying a bit in his introduction, which is short-term and long-term. He mentioned he's a long-term investor, unless there's some things, within your industry, within your expertise, where you may want to shorten that a little bit. Once again, the note business can deliver on that as well. You can be in these notes as long as potentially 30 years, which I would consider long-term, or you could be in these things for as little as a month. Okay. Now that's a little leverage technique, but to make that more reasonable for people, what if you could buy a note and only be in it for 5 years? And what if the note, which is secured by real estate, what if the note is paying you 10% per year? That's an alternative versus putting that money into a 5-year CD, right? Where it's backed by the FDIC up to $250,000, right? So you have some guarantee within that, but you've got your money locked in there, and in a CD is going to end up paying you 1-2%. Okay, so there's some great alternatives in the industry today, and again, because of the maturity of the industry, the way it has grown, it's opened up more opportunities for all investors to participate. And I think that's why it's risen to this status of its own asset class in the overall marketplace. Okay, let's slow things down a little bit here for some people who may be new to the business. And I'm going to explain this concept very, very simply, because we have to start with, well, what the heck is a note? Okay, so a note on its most basic term is an IOU. It's a written IOU. If you're borrowing money from, in this case, a bank, you have to promise it back. And that's what the note is. It's your promise to pay. And in that note, it's going to talk about how much money you have borrowed, what the payback period is, what the interest rate is, when the payments are due, where you send the payments, all of that. And it's a form of an IOU. It's your promise to pay in writing. Now, if you went into a bank and you were to borrow money and all you did was promise to pay it back in writing, what if you break your promise? That's what the bank thinks. They're hoping for best case scenario, preparing for worst case scenario. Best case is you live up to your promise, you make all your payments, no problem. Everybody got what they wanted. But banks are smart investors. In this business, by the way, we become the bank. So you want to be smart investors as well. As a smart investor, they're preparing for worst case scenario. And worst case scenarios, you break your promise. So you stop making those payments. Now, all of a sudden, I have this note that would be considered unsecured at that point in time. Do I have legal recourse? Sure. I could sue somebody if they promised to pay me back and they didn't pay me, but that again is costing me time and money, and I would have to weigh that out. Our industry is referred to the note business. We say that we buy notes in the business, but the reality is we don't just buy notes, because notes in and of themselves is just a guarantee in writing without backing. The reality is when we say we buy notes in the business, or I'm investing in real estate notes, we have notes, but the notes have an attachment to it, which is a security agreement. Now, the security agreement on your screen here is a mortgage, right? There's also a couple other types of security agreements, but let's stick with mortgages. That's what most people understand. When we buy a note, we're actually buying two documents. We're buying the IOU, and we're buying the security agreement. We're buying both of those documents. That's what builds in the strength and the security in buying a note, because the mortgage says essentially, if I don't pay you back according to my note, according to my IOU, then you can foreclose upon the property. In other words, I don't pay you, you can take the property from me. Okay, now how we take that property, judicial, non-judicial, is a whole other discussion here, but they all do the same thing. If you break your promise, then the lender, if you will, can go after the property. So if we buy a note that's already been created, and let's say this note was, this one actually was created by direct mortgage funding. So if this was created by direct mortgage funding, and we bought this note from direct mortgage funding, we step into their shoes. So we become the lender, if you will. Okay, now that we're known as the note holder, the note owner, but that's the role that we play. So we get a passive cash flow off of this note, and it's secured by the property, which in this case happens to be a single family home. And by the way, in this presentation, when I put this together, you're going to see that picture a lot. So that's just a generic picture of a home. So I'll use that multiple times in multiple case studies. So I don't want to confuse anybody on that. So that's really all a note is. When you combine that with the mortgage, the property becomes the collateral for the note. So going back to my initial example, is it important for us to know what the value of the collateral is? Yes. So now going back to my same numbers, if I know that the house is worth by BPO, by appraisal, $100,000, and I'm buying the note on it for $50,000, I've got security within there. Even if that property value goes down to a point, even if it drops down to $80,000, let's say something traumatic happens and it drops from 100,000 down to 80,000, I'm still only in it for 50. Okay, that's what gives us the security within these instruments here. So I'm going to take just a minute because I do see, okay, got that one. I saw a couple of questions popped up. Great. Okay, they're asking the same question there, so I'm sure NuView is handling that. Okay, fantastic. So I'm going to move on here with that. And again, I know some of you may understand this, but I go over the basics at every training I do, because I have even the most advanced investors come up to me afterwards and go, you know what, I kind of forgot about that. And I'm telling you, to do this business, you have to understand the fundamentals. We buy these documents. We buy these documents. And how many people listening right now and watching this have ever gone to a real estate closing? You purchase real estate, and that could be within or without your IRA. I'm just saying, maybe your own home, you bought real estate. And what happens at a typical closing? Well, people are just signing away, signing away, signing away, right? Nobody listening would do that, right? You read every document, right? Yeah, sure. You didn't read all the documents. Okay, which means you didn't really know what was in them. You heard a very brief statement from the title company person saying, that's a document that says this, that one says that, and you're just going, okay, where do I sign? In the note business, and by the way, advanced real estate investors are guilty of the same thing, hence my point. In the note business, we have to have a little bit more knowledgeable in those contracts, because in the note business, we're not buying the property. The property is just our collateral. What we're buying are the contracts. So we have to understand the contracts. Now, we may end up with a property, and it's important to us to understand that property value and everything else leans upon it, but we're not buying the property, we're buying these instruments here. So we can break down notes into two major categories. When we buy a note, the note could be performing, meaning the payments are being made on a regular basis, or it could be non-performing, which means that people are currently not making the payment. Now, there's categories in between, sub-performing and that sort of thing, but those are the two major polar categories. It's either performing or it's not performing. Okay, let's take a look at a performing note first here. Every example that I use, by the way, is typical numbers within the industry today where the best deals are. I'll say that one more time. All the numbers, all the ratios that I use in my presentations do reflect the best deals in the industry, which is lower price band. We have a tendency to invest where the property is worth less than $150,000. Now, you can buy notes in the higher categories, and I do teach that. It's just a little bit different game up that level. You pay a premium for that. So the numbers I'm using here are very, very realistic in regards to returns, in regards to property values and everything else. So I'm not cherry picking the best numbers. I'm showing you what the market valuation is in today's marketplace. So if I buy a performing note and it's backed by a property worth $80,000, what does that look like very briefly? Okay, if we buy a performing note, when we buy notes, we buy them at a discount. Okay, so we pay less than what the balance of the note is. One of the criteria that we look at investors to identify our risk first is to compare what our investment is as it relates to the value of the property. So in this case, we have an $80,000 property, and I'm investing, I'm going to round it down to $40,000. So I would be said to have a 50% investment to value ratio, which is very safe, right? I'm in it for 42, the house is worth 80. If I have to take that property back, if things go wrong, right? I hope for best case scenario, prepare for worst case scenario. If I have to take that property back, am I okay? That's what we have to think about. And I think if you looked at this and you said, well, yeah, if it's essentially where I've paid $43,000 for an $80,000 house, you're exactly right. Okay. Now, we're not buying the house once again. That's our collateral. So we're buying really an income stream. That's what these notes represent. They don't represent a lump sum, if you will. We're paying a lump sum to get what back? Monthly cash flow, okay? Passive monthly cash flow on performing notes. So if the monthly payments on this are $433.32, I'm paying $42,766. So let's put it in terms you would understand. You have your NuView account and you wanted to invest in notes, right? NuView's going, yep, notes are an allowable investment, right? And you say, okay, here's one I found. This is what I want to invest in. As you all know, they don't say good investment, bad investment. You choose to invest in that note. So you invest from your account $42,766. What are you getting in return? You're getting in return $433.32 per month for 18 years. Okay. That comes out to a 10.6% secured annualized return. So you're making on your $42,766 investment, you're making 10.6% per year, but it's also secured. Okay. It's secured by that property. Now, hopefully that property goes up in value every year, right? And therefore you're getting even safer every year because they owe you less money and the property's going up in value. But if it does take a downturn, which let's face it, we don't know what the outcome of this virus is going to be, how long it's going to last, how many people are going to be unemployed. If property values do go down, you've got that safety in the numbers here. That makes sense to everybody. Okay, what about a non-performing note? In a non-performing note, again, you've got the same two instruments. It's just a note and a security agreement backed by a piece of real estate. But if it's not performing, you wouldn't expect to pay a premium for that note. You would expect to get that at a deeper discount. I'll just relate that to real estate. Anybody listening could go out and buy a piece of retail real estate on a house that's been fixed up or is in good market condition. You could buy that house, no problem. You're not going to make a whole lot of money on something like that, right? If you buy a fixer-upper, okay, do you expect to pay the same price as a house that's in market condition? Of course not. I know the answer is obviously, of course not. You are going to have to discount that. It's a broken house. Okay, we buy broken notes. This is a broken note. Okay, somebody could still be living in the house, but they don't have the ability to make those payments on that loan. It's a broken loan. So what do? We buy it at a deeper discount. So again, using market prices here, that same house that's worth the $80,000, we might pay in this case only $28,000 because it's a non-performing note. Okay, deeper discount. Now we're only in it for about 30%, just under, well, about whatever that comes out to, about 30%, I think, in that note, or excuse me, in the property, our investment to value ratio. We paid $28,000, it's worth 80. So we've got more of a margin within that, okay? That's the first thing we look at. We then will either end up with that property, or perhaps the people in the house do get the ability to start making payments again. Now, maybe those payments have to be adjusted. Maybe we have to modify the loan a little bit. Maybe we do a temporary loan modification. Maybe we stretch out the loan to lower the payments. Maybe we adjust the interest rate. Can we afford to do that? Sure. We only paid $28,000 for that note. You see, what happens in this business is we being entrepreneurs and investors like you and I, we are the ones who saved the real estate market from the last crash. When we had all those foreclosures and all those problems from the crash in 2008, where we had almost 5 million people facing foreclosure, the government tried to fix it and failed. The banks tried to fix it and failed. What they ended up doing was getting away from foreclosures, bundling up mortgages, and selling those mortgages in bulk to big Wall Street firms. The big Wall Street firms would keep the stuff they want and then pass along the other things to investors like you and I. And that's why we got deep discounts. We can come in and modify loans like that. Now, technically, banks could too. Why don't they do that? Banks are big bureaucracies, right? Banks don't look at, if you bought this note for 28 grand, the people are still living in there and they're willing to make payments and take care of the house if you would work with them. I think you're going to do everything you can to work with those people, help them stay in their home, and you're making a great return as well. It just makes sense that someone would do that. You're looking at them as an individual investment as well. Banks don't. Right? Banks have too many loans, too many people. They can't look at it that way. They think in terms of portfolios, whereas note investors, we think in terms of individual notes. So we do have some advantages. I'm pointing some extra things out here because if the economy does go down, if housing does go down, we're going to be the ones who are going to ultimately help recover this market once again. So it makes sense to position yourself where if that does happen, you know what investment opportunity to look at, because we're looking at a potential fourth wave, as I will call it, fourth wave of inventory here if this virus keeps people out of work for several months. And we can only bail out so much, in the overall economy. So either way we look at this, it comes down to, once again, what's my collateral? How much am I investing for? And then we have all kinds of workout solutions that we can apply. That's what makes these notes low risk, high yield. I think everybody would consider, I showed you just one example, typical return, 10.6% on your money per year secured. Where else can you get that? Especially on a passive basis, secured by real estate. And that's the key to this whole thing. That means that notes can work on both sides of what you may be looking for. It generates income and it creates wealth, right? So it can do either one. Some of you, you might have money in your IRA that you want to do for long-term wealth. Can you invest in notes outside of your IRA? Well, of course. And maybe you want to buy some notes there for spendable income. right? And you can do the same thing. So you can invest obviously in both ways, in your NuView trust accounts and also through your other cash accounts, investment accounts, or what have you. And then how you invest will determine if you're generating income and creating wealth. And of course, there is a difference. I think that's pretty obvious. You could make a very good income. You could be making $200,000 a year, but you might just be broke on a higher level. Right? So wealth is a whole different thing. With the note business, you can start to build up that wealth, because imagine making that 10.6%, but now it's tax deferred, right? Through your retirement accounts and Roth and all that sort of stuff that you all know already. So that's another big dynamic within the note business, that there's so many different things that you can do. It comes down to what can the note business for you, and then you can target. Should I be in non-performing? Should I be in performing? Should I be in both? Should I invest within my IRA? Should outside of my IRA? Both. And that's where you come up with a good plan. So yes, it can generate passive monthly income. It provides lump sum payouts, by the way, as well. I'll show you a technique on that. And you can acquire real estate at deep discounts. Now, maybe that's your other goal. Maybe you go, I don't really want to be in the notes. I want to acquire real estate. Well, wouldn't you rather buy real estate at 30 cents on the dollar than 80 cents on the dollar? Especially in a market like this right now, where there's a lot of uncertainty. I'd much rather be buying at 30 cents than 80 cents on the dollar. Where am I getting 80 cents a dollar? Go to a foreclosure sale. If you haven't been to a foreclosure sale in the last several years, people are paying more than 80 cents on the dollar for as-is property. It's crazy. So let me give you some examples here of how to generate passive monthly income, how it provides lump sum, and how you can acquire real estate at deep discounts here. Okay, so again, same picture. It's just a generic house, and you're going to be a note owner here. So what this note is going to do is provide that passive monthly income. So if we buy a performing note, what we're getting is monthly income. But this monthly income is very different than landlord type of monthly income. Remember, we're not a landlord here. We don't own the property. The borrower owns the property. We're acting as the bank. Okay, so we just get the monthly passive cash flow. We don't have to deal with the tenants and the management and the maintenance and the headache. I can't tell you how many times I have landlords go, well, I make this kind of, cap rates on my homes, and then I say, well, what happens when you have a major expense? Boom, it can wipe that stuff out in a heartbeat. How do you like dealing with tenants? I have a lot of people own rental property that come to me and just say, I get it. I don't want to be in the rental property business anymore, but I would like that cash flow. This is your answer right here, because let's face it, if you own your own home right now and you have a mortgage that you're paying on, do you call Bank of America when you have a roof leak, right? No. You don't call the bank. You're the bank in this example. So you're getting passive monthly cash flow without all of these other headaches. And of course, these investments are recognized and fully allowable for all your tax sheltered accounts. So those of you with IRAs, 401ks, both, if you've got all the other various health insurance plans and all those sorts of things that NuView talks about, you can invest in these types of assets, no problem. That passive cash flow, of course, is coming, if you're using your IRA or 401k, into that IRA or 401k, but it's passive. You don't have to worry about all of these other issues right here. Okay, how do we handle it? Don't I have to collect the payments? No, there's servicing companies that you utilize. So the servicing company works like this. You hire a servicing company, which can be anywhere from $15 a month to $50 or more a month, depending upon what you want them to do. On a simple transaction like this, where you're buying a performing note, you might be paying $15 a month. So when the payment is made, the payment goes to the servicing company from the borrower. That can be auto deposited. It could be a check. It could be whatever. It goes to the servicing company. The servicing company accounts for all of that. They keep everything online. They show you when the payments come in. If it's being escrowed, they handle the escrow to pay taxes and insurance. They do all of that. They take out their $15 and they send you the rest of the money. That's how it works. Or they send your IRA, obviously, the rest of the money. So you don't even get involved with that. If the payments are late, servicing company handles it. right? They'll collect that late payment, that sort of thing, and work on that. If something goes wrong, if it becomes non-performing or there's an issue, then they will contact you and wait on your instructions on what to do in that scenario. But that's essentially how it works. So it can be very, very hands-off. Servicing companies simply managing all the cash flow, accounting for that cash flow. And a lot of the servicing companies provide other services as well if you need those type of services. Okay, another scenario there. So that one was passive monthly income. Let's get back to a non-performing note here. If you invested $28,000, I'm using the same numbers as before, you invested $28,000 in a non-performing note backed by this $80,000 piece of real estate. Well, what could happen here? Well, first of all, what are you really owed if it's non-performing? Okay. Whatever the balance is on that loan. So the house might be worth 80 grand. They might owe 85, right? That could happen. They might owe $70,000 on that. Whatever it is, for the case of this example, it doesn't matter. What you're owed when you buy a non-performing note is the unpaid balance, the arrearage account. Those are all the missed payments. So if somebody hasn't been making payments for 2 years, you got 24 months of payments plus taxes and insurance that you are technically owed. Okay. And there can be penalties and such that apply to that as well. So when you buy a non-performing note, you're technically owed the unpaid balance, the arrearage account, and all the penalties. Now, will you collect on all of that? It depends. That house might be vacant. Well, if it's vacant, chances are you're not going to ever get a reperforming note out of that. What you're going to end up with is the real estate. But there could be people living in that house. They haven't made a payment for 2 years because they don't even know who the lender is. Maybe they temporarily lost a job. Now they're working again. They can afford to make the payments, but they haven't made a payment 2 years because they're like, well, even if we made one payment, the bank can still foreclose. And they're right, because these loans do have acceleration clauses. So it wouldn't make sense for them to make a payment unless they had a commitment from the bank that says we will forbear. That's where you're going to hear a lot about forbearance agreements. You probably already have in this marketplace. That's where you say, I won't enforce this acceleration clause. You still owe me the money. I'll move it to the back of the loan, but I'm not going to use that to foreclose upon the property. So if you start making monthly payments, and by the way, we do that kind of stuff all the time. We help people stay in their homes because I could do, in this case, a trial loan modification with somebody, let them start to make some payments. What can they afford? Do a trial loan. After 6 months, if they can meet the terms of the trial loan, then I'll make a permanent loan modification. Family gets to stay in their home. Kids get to stay where their friends are. They get the same schools, they get the same location. And that's a great thing about this business too. We're helping people. But here's another scenario. What if the people living in this home say, look, the house, technically worth $80,000, and I'm going to paint a scenario here. The house is worth 80, and let's just say they owe $80,000. They have no equity in the property. Okay. And you bought this note for 28 grand. And they tell you, maybe the homeowner or maybe the homeowner's real estate agent says, hey, please don't foreclose upon us, because we do have an interested buyer in the property who's an investor, but the investor's only willing to pay $50,000. Would you be willing to accept $50,000 as a short payoff? So maybe I'm owed $80,000 plus arrearage and such. I only invested 28, and they're offering me a lump sum of $50,000 to tear up the loan. I don't know what you all would do. I know what I would do. I'd take the $50,000, tear up the loan, investor buys the property, the family who is in there moves out, and they're on with their lives, and everybody gets what they wanted. So a short payoff. I think you'll probably start to see some more short payoffs in the marketplace, depending upon how this whole thing plays out and how long this lasts. So the house technically then is sold for $50,000. Well, who gets paid first? I do. I'm the first loan holder. I was owed 80. I was willing to only take $50,000 for that. And by the way, we can structure that because some of you might be more advanced and thinking about, well, aren't they going to have to pay the phantom tax and all that sort of stuff? No, there's ways that we can do it where they don't have a taxable event. If a lot of you didn't understand what I just said, don't worry about it. Don't worry about it. We can have that conversation when you get down the road. So in this case, you would get a lump sum for that. Some people might just even want to pay off the loan. They might just say, look, we've been in the house, we did this and that, and we're trying to talk with a lender who would work with us. We can't get anywhere. And you're all of a sudden now you're the lender through your servicing company, and they make an offer to pay it off. It happens all the time. There's one example of doing a lump sum type of deal. Let me change it up a little bit here. You invested the same house, same numbers, same investment amount, but in this case, the people just, they don't have the money. Maybe you tried to help people and stay in the home and that sort of thing, and they just couldn't do it. So you give them a deed in lieu with maybe some cash for keys. Here's $1,000, a couple $1,000 to help you move, keep the house in good shape, deed the property over to me, and I'll forgive the entire loan. You won't go through a foreclosure. You won't have that on your credit report and anything like that. I'll forgive all of that 80,000 plus you owe just by signing the deed over. That's what a deed in lieu is. Okay. And we can combine that with cash for keys. Maybe the house is vacant. If the house is vacant, I can do a skip trace to try to find the borrower and make the same offer, a deed in lieu, or I might have to ultimately foreclose. So if I have to foreclose, I could either get a lump sum payout at the foreclosure sale, or I'm going to end up with the property. And that just depends on how I set the bidding on this property. Okay. So that's how all of that works. So just to give you, again, quick examples here tonight, we got low risk, high yield, secured by real estate. It can generate income. It can create wealth. It can do passive monthly. It can do lump sums. We can acquire real estate. We can purchase notes, and we can also broker and or partner with notes. We can use leveraging techniques for that. I can show you how to invest less than $500 in notes. And that's why, as a part of this, when you got the emails on this, they said I was going to talk about how can somebody with a small balance IRA get started in notes. It's coming up here. So I'm going to pick up the pace just a little bit. I'm keeping an eye on the time here. This I'm going to go through relatively quickly, this little segment. It's kind of setting up why the inventory is where it is. And I'm not going to spend a whole lot of time on this one, because I'm going to have to redo this one and add the fourth wave, the fourth wave, because the fourth wave is coming. It's just how big of a wave it's going to be is going to depend upon how many people are out of work and for how long, and what government procedures are going to be put into place, all of which is kind of up in the air right now. So the third wave of note inventory. So I'm not going to go back 20, 30 years when I first started in this, but the first wave that really brought the note business to the highest pinnacle in real estate was because of the risky loans back in 2004 and 2008. Okay, that's when people were getting 0 down, 100% financing, heck, even 110% financing, pick a payment, adjustable rate, the so-called liar loans, all of those sorts of things were going on, crazy lending practices. Obviously, that crashed because people were getting loans they should never have gotten, and the whole thing came tumbling down. Banks couldn't handle it, government couldn't handle it, so eventually they started just selling the properties, selling the paper, and that became a huge, massive wave of inventory, which we're still dealing with today, by the way. We're still working through that inventory. It's taken this long to deal with all of those, but it's been a great ride in the note business as a result of that. The second wave that we had was a smaller one, and this was hurricane related. We had hurricanes in Florida, we had hurricanes in Texas, and anytime you have natural disasters like that, what happens? People lose their job, people have property damage in this case that was unrecoverable for a lot of people. Excuse me. So that was a wave. And once again, the banks weren't there bailing people out. The banks bundled up the paper, sold it to the big Wall Street firms. They kept what they wanted. We bought the rest, and we did the real hard work of helping people get back their feet on the ground here. The third wave is fairly recent, 2019 and 20, because of what's going on in the lending industry. Okay, and this is not a good combination for what potentially could happen in the future here, because the lending laws started getting very loose again. And the government was backing, once again, all of these loans. But the major shift in the industry has been there's more lending companies that are non-banks than there are banks doing mortgage loans. And that opens up a bunch of problems I could go into, but I'm going to stick on task here. Let me just briefly show you this. Government insured loans overall had a 1% increase last year, which doesn't seem like a lot. When you break it down, there was a 31% increase in VA-backed loans and a 17% increase in FHA-backed loans that went into default. Okay, that went into default. 1% increase overall last year, but 31% VA and 17% FHA backed loans. That is not a good thing. In fact, in government reports, which I read, in the last government report, it noted last year, high debt to income ratios, declining average credit scores, and low down payment assistance are going to be a problem. It's noted in the government reports that VA and FHA have to report to Congress. It was noted back in 2019. The problem has gotten worse, not better. More private lenders are doing loans versus banks. I mentioned that nationwide, national lenders increased 3%, but private loans from non-banks like Quicken, okay, Quicken doesn't answer to bankers. Quicken answers to shareholders, right? They don't have depositors like a bank does. Private loans increase in the mid-market, remember I said about $150,000 homes and less, increased 139%. They don't have the same strict guidelines as banks do. So they do looser loans, non-qualified mortgages. Look at the numbers here from Black Knight Financial Services. Delinquency rate of 6 months after origination trending higher. Upward trend on Ginnie Mae backed loans. Ginnie Mae backed loans are wholly owned. Ginnie Mae is wholly owned by the United States government, us taxpayers. So that aside, another wave potentially is coming here, but we still have so much inventory. That's why the prices are so great on these things for investors, and the industry welcomes you. We can help a lot of people out in this industry. How do we find notes and purchase notes? There's trading platforms out there. There's companies like Loan MLS. There's PaperStack is my favorite. I know the gentleman from PaperStack and meet with them on a regular basis. They're right here in Orlando as well. And that's a trading platform. You can go on trading platforms and you can Google search trading platforms, note trading platforms and such, and look around and see what's out there. And there shouldn't be a single trading platform that charges you anything to register. You're just registering, you created an account, and that sort of thing. And you can look around and get a feel for the overall inventory and prices and returns and such. And PaperStack makes it pretty darn easy. I do have a working relationship with PaperStack, by the way. I oftentimes teach from their platform, so just full disclosure there. But there's also individual note sellers, and I think this is going to be a big area. And let me explain this one quickly here for you. Individual note sellers are what the industry often refers to as mom and pop notes. Mom and pop notes is where the industry started. If we go way back to the late 1970s, getting a bank loan, getting a mortgage backed loan at a bank, you were paying upwards of 18% interest. 18% interest, bank rates on a loan. A lot of people then said, well, I'm not going to buy a house and make payments on an 18% loan for 30 years. And the sellers were like, you don't have to. I'll seller finance it for you at 9%. Okay, that may be the only note that person ever creates. So there's individual note owners like that today, but there's also individual note owners who are real estate investors. They buy a property, they fix it up, and they sell it. But because a lot of people still can't qualify for loans, they sell it with seller financing. And then they want to sell that financing here. That's been untapped. And I know what's going to happen is some of these people are going to need cash, right? So they're going to want to sell this paper. You can find those people all day long. It's an easy way to do it. And then you can start to buy deals like this. This is an actual deal. I just took the name off here and I rounded the numbers. Imagine this. And you can buy these today right off the shelf, if you will. 3-bedroom, 1-bath, $50,000 property, 43 payments have already been made. And you can see it's principal, interest, taxes, and insurance. Sold with seller financing. Okay, from an investment company. And the purchase price on this one, well, sorry, the people put $750 down and they created a note for $53,000. But the people have made 43 payments already. They're still living in the house. The investor who bought this one paid $23,400 for what? $504 a month for 209 months. the note was already written at 9.99%. In other words, if he had paid the unpaid balance, the $52,665, he would have been making 9.99%. If you're paying less than that, your yield goes up and your risk goes down. Remember I said low risk, high reward. Classic example from an actual investor here. 47% investment to value ratio, 25% return on investment per year. This is the current market that we're in on these type of deals. Now, again, imagine you did that through your IRA. So choices for passive investors. And just let me know, Olga, Grace, or Jason, how we're doing on time here if you need me to jump ahead. It's not advancing on the slide there. Do you have it or do I have it? There we go. Okay, so as a passive investor, you got choices, right? You have money in your accounts. What do you want to do? Stock market, everybody's probably a little scared about that right now. Bonds aren't paying anything right now. And bonds, by the way, you buy T-bill, what's it backed by? The full faith and credit of the United States. That's your collateral. So far, we've never, ever defaulted. Our notes are backed by the real estate. Cash-like investments, rental properties, you get the point. You got choices here. One of the things I like are buying short-term notes. Okay, so the examples I showed you there were long-term. You can also buy short-term notes. How do you buy short-term notes? I refer to them as turnkey notes. What's happened in the industry, because it's matured a lot, is you have investors now that own portfolios of notes, and they like to recapitalize from time to time. So they may be willing to sell you a portion of their note. 5 years is very popular right now. So actual numbers here in Houston, Texas, $130,000 collateral value for the property. The people have already made a certain amount of payments. That might be 3 years, 4 years, 5 years, doesn't matter in this example. And you just purchased the next 60 months of payments. So maybe they made 3 years worth of payments. You're buying the next 5 years of payments. First of all, your risk is lower because your overall investment is lower. It's still backed by the same property. You're in the most senior position. You paid $42,400 for the next 5 years worth of payments of $880 per month. Let's see. I had the yield on there, I thought. Yeah, there we go. So that gives you a 9% annualized return backed by a property that's worth 3 times more than you have in it. Very safe, low risk, high reward, and you're only in it for 5 years. Again, what would you rather do as a passive investor? Buy a CD, buy a T-bond, right? Put it in the stock market for 5 years, or make 9% on your money secured. All right. Can be done from any place. Internet connection, analysis, once educated, okay? 20 minutes or less. Verification by third party. There's auditing services today. You don't have to travel anywhere. You don't have to look at doors. You don't have to go out and look at a bunch of property. You can look right online and get that done. Receive automatic payments, once again, through the servicing companies. Okay. And let's see. Funds, there's funds out there today. Aspen Funds, they were at the P4P event. They work with accredited investors. The MWM Fund works with non-accredited investors as well. The minimum investment on an MWM Fund investment is only $200. So I don't know if I have the slide control or somebody else does. Maybe I got ahead there. So there are funds as well. If you want to invest passively in a fund where you own a small percentage of the entire portfolio, Aspen Funds for accredited, non-accredited, and accredited, mwmfund.com. You can find it there. More information on me, kevinshortell.com. I did set up a free video to follow up on this. So if you're more interested in how to buy notes for under $500, it's a free video. Go to my website, pop-up window, fill it in. You'll have that. Of course, I have other courses and such. Free podcasts, Kevin Shortell Show, do that on a regular basis, and a free blog and YouTube channel there. So I've run a little long on my time, and we want to have time for Q&A. So I'm ready when you guys are. Who's running the boards back there?
Oh, there we go. Hey, sorry.
Hey, there he is.
We could probably go back to that last slide there. Perfect. Awesome. Well, hey, first of all, Kevin, thank you. Thank you for walking through kind of the different stages of notes and types of notes. Um, I've got a couple questions that have popped up, and then
Okay.
we'll go through that process. So just for a couple house cleaning tips, if you do have questions, we're going to take Q&A for the next probably 5-10 minutes. If you do have questions, feel free to open up the Q&A section and type them in there. We'll see those here on our end. I got a couple questions for you. You know, obviously, the first one has to do with the state of uncertainty that we're in. And I think we're in uncertainty today, not even so much because we're in a bad economy. I think we're in uncertainty because this is really nobody, no matter how old or young you are, has ever lived through this.
Right.
So given that, you know, what is your, you know, maybe advice, words of caution, things to be considerate of when looking at notes and trying to underwrite a deal that maybe in 6 months may look way different than it looks today. Whereas if we had written a note a year ago, right, 6 months probably doesn't look a whole lot different. So
Yeah, I've already been advising my clients on a couple of different levels. I've already advised people if they already have notes, I said, keep in constant contact with your servicing companies, especially around the first week of the month, right, to see if your payments are coming in. And I would already have prepared I would look through my portfolio and have prepared letters and such if I need to reach out to people and just explain, look, if you're having struggles making that $800 a month payment, communicate with me. We can do a temporary loan modification where we can lower your payments for the next 3-4 months. And I think it's smart to be proactive on that, because the worst thing you can have as a note holder is a person just doesn't communicate with you. And then it's no payment coming in and you don't really know where you stand. If you at least reduce the payments temporarily, maybe they can afford $400 a month. Okay, your yield goes down, but you've done a goodwill to the people, which will pay back later. You still have that revenue coming in, and it's temporary. And once it adjusts, you can start to adjust it back up again if you already own notes. If you're looking at buying notes, first of all, if you're not educated, let's start there. You got plenty of time to do that right now. But we still, actively looking at notes on a regular basis. What you have to monitor is how much you're paying. So what you're going to see is the price of notes are going to go down, because the assumption is going to be this reperforming note might not stay reperforming. So we protect ourselves by paying a little bit less on that. And when you buy non-performing notes and the people are still living in the house, you normally go in there at such a low rate where you're going to do some kind of trial modification with them anyhow. So I think you're still in a good position with that as well. So it's just some slight adjustments in the procedures on that. And again, just watch your risk first and then reward second.
And on that note, you know, you talked about modification. I love that, because there's, you know, I think one of the things that in any of the notes that I've ever done and any of the people I've ever, you know, dealt with, real estate investors alike, it's all about being proactive, right? You know, let's not wait till things get too bad. Let's get out in front of it. There's a ton of chatter and social media is a buzz about, you know, people not needing to pay rent, people not needing to pay mortgages and suspending mortgage payments. And, you know, obviously if you're Bank of America or your Fannie and Freddie or whatever, you know, these big mortgage-backed security, you know, funds, it's not the end of the world. But if you're Joe Sixpack and you've got one loan out there or 2 loans out there, missed payments or missed rent, and I think we could talk about real estate and notes probably in a similar breath here. What are you seeing as far as ideas versus what does reality look like in that? And what would you, you know, say to everyone that's on the call today about how to manage that, you know, and what to expect if the government steps in and puts any guidance on that?
Yeah, a couple of levels on that. I haven't seen anything yet because it hasn't really happened yet. You know what I mean? The first of the month is coming up here, and it's kind of happened after people, we assume, made their payments in March. But you're right. When the government puts it out there that we're stopping all foreclosures and evictions and everybody's going to be doing forbearances, people don't think in terms of, well, that's on bank loans, that's on FHA loans, that's on HUD, backed loans. They're thinking all loans. So that's where the awareness as a note investor, you're like, uh-oh, be more proactive. And I would, again, start to reach out a little bit with people and just I would let them know, first of all, hey, we're here if you need some assistance, and maybe do some clarification in those letters. But I think it's going to be important to be more proactive. But you know what, at least we have a heads up of where that's heading. You know, it didn't blindside people like before, where just everything crashed. You know, what I mean by that is, if you're a real estate investor, certainly full time, I don't care who you are, 2008 came, you lost money. It was just a matter of how much, because it happened so quick. There was really no, well, warning signs, but not as quick. Here we have a little more, look, we know that people are going to be out of work. We know that's going to happen. So just be prepared and be a little bit more proactive on that.
And on that note, you know, obviously you're incredibly bright about notes, and you've been doing this so long, but you know, a lot of our clients are very passive. You know, we have thousands of clients that may buy, you know, a couple of properties, or I'm sorry, a couple of notes, and their intention when they buy it is to do it passively. They're not interested in reperforming or performing, non-performing. They simply want to go out and either originate a new note or buy a perfectly, you know, performing note.
Right.
What resources would they possibly look for, right? Obviously, I'm not prepared to pick up the phone and call my note holders and stuff. I don't know that speech as well as you do. Are there resources, servicing companies, groups, organizations, clubs, memberships, anywhere out there that these individuals could go and get some help on this proactive communication?
Well, if you mean through servicing companies and workout companies, yes. So technically, servicing company just collects the payments and accounts for it and holds escrow. Workout is anything else: knocking on doors, you know, delivering stuff, tracking people down, negotiating workout strategies. You could outsource today, because of the growth of the industry. You can outsource literally everything. You never have to talk to a single person. So if you're a passive investor, and let's just play worst case scenario, you bought a performing note, everything's perfectly performing until it wasn't, and now you've got a problem. Well, you can essentially outsource that problem and say, well, find out what's going on, let me know, and then you still maintain the control of making the decision. I could tell them my guidelines, or I say, give me the information back, and they say, well, the person can't afford $800 a month, but they can't afford $600 a month. You want to do a temporary mod, and all you have to do is go yes or no. And they'll handle that. They handle all the paperwork. So, I mean, it can be really, really outsourced today. We didn't have that luxury, you know, 10 years ago, but we do have that today because of these niches. One of the guys I work with, he's based out of Arizona, but does business nationally. He's almost a one-stop shop. You know, what do you need? A BPO, you need secure property, you need to track somebody down, you need to negotiate a deal, you make one phone call, and he's got agents throughout the United States that can handle it. So there's a lot of that. It's almost to the point, Jason, really, where you can be as active or as passive as you choose to be. You know, is there a cost of being passive? Well, sure, because you're outsourcing that. You know, there's going to be a cost to pay people for that, but sometimes it's based upon their performance too.
Okay. And let's turn to some questions coming in from the audience. And I'm going to read them as they state. If there's anything in there that comes across, you know, maybe whoever asked the question can go back in and retype it. It says, what if you buy the portion, the 5-year note, and during your period of repayment, the house ends up becoming non-performing?
Yeah, I've never had that question before, right? Good question, because you should be thinking that way, right? Hope for best, prepare for worst. Worst case scenario in that example is just as you stated, whoever asked that question, which is, I own this segment out of this segment, but it went non-performing in mine. Okay, it depends upon the contract that you signed. All right, when you buy a partial, there's a partial sale agreement in there. And technically how it works, unless otherwise stated, as you own that note during that period of time. In my example, it was 5 years, and then you agree to give it back to the person after that 5 years. So the responsibility lies upon you. Now, in the real world, though, there's other solutions that come in, and it depends upon the relationship you had with that investor. So normally what happens is, if you buy a partial, well, what do you want to do? Do you want to foreclose upon the property? You could initiate that foreclosure act. A lot of times, if it's a smaller balance, the person who owns the back end of that note, they're vested as well, right? They want to get that note back. They might just pay you off. They might say, look, why don't we try to acquire the property through a deed in lieu, and then we'll sell it with a new note and we'll restructure a deal. So there's a lot of different workouts to that. You're in the best position when you buy that smaller front portion because you're the most senior lien. There's not two notes, right? It's still one note, but you're the most senior part of that note. So you can start to implement exit strategies with or without the cooperation of the back end investor, the one who owns the back. Normally what will happen though is that back end investor, they want it to work out, so they'll work with you to a resolution, whether that's a payout or restructuring a deal. That all depends.
Well, and you hit on a couple things that I think are worth reiterating, and that is, number one, it's the agreement, right? As they say, if you can't afford the attorney, you can't afford the deal. We see this all too often. We have over 16,000 assets on our platform today. We've probably done 30 or 40 or 50,000 investments over the last 10 years. And inevitably, everything is good until it's not good, right? And what happens is anything that, if Kevin and I are doing a deal, and anything that we talk about really doesn't matter 7 years from now if that asset is defunct in some way, shape, or form. What comes down to brass tacks is, what did we put in writing, right? And what does that mean? So we've seen so many deals that have gone bad. And so if you're going to be partnering, right, it is not like a marriage, right? Marriage can be unfolded. This is something that you have to really take a hard, strong look at. What does the agreement say? And really talk through what happens when this goes bad, right? And hopefully that never happens, but what happens when?
And the contract should identify that. Yeah, you're right.
Yeah, if you don't think about that at the time, you could be setting yourself up as we approach some uncertain times. I can tell you there's going to be a lot of legal disputes that we're going to have between account holders and parties that they've done deals with, because somebody's going to be left holding the bag, right? Potentially, if a deal doesn't work out the way everyone had intended it to. But there's got to be some really strong agreement there. So choose your partners very carefully. Understand who has what level of control, and understand what your legal recourse is. I think for me, the most attractive part about notes is it's the only investment you can make that has a predetermined rate of return that you can collateralize 100% to your liking. I mean, you don't have to write a note at 80% collateral. You don't have to write it at 60. You can write it at 10%. Now, you may not find anyone willing to put 90% down, but the beauty is with notes, you have all of those luxuries. But make sure that you're acting in the best interest of yourself, right? Be a good business partner, but make sure you're getting good legal counsel on those deals, because without it, you could find yourself unfortunately holding the bag on something that you didn't anticipate.
Right.
Next question. It says, do all the activities with the note get recorded down at the county clerk or through the servicing company? And I'm kind of reading that. I don't know if I've read that out right.
Yeah. I think I know what they're saying there. What documents essentially do you record? You record the ones that are required to be recorded. True statement, but I know what you mean. So what you record, what's interesting in this business is you don't record the note. Notes are not recorded because they're considered personal property. But remember, we're not just buying a note, we're buying two documents, the note and the security agreement. So we record the security agreement in the county in which the property is located. That's what needs to be recorded. Now, unlike a real estate transaction where the title company or attorney does all that for you, it doesn't happen that way in the note business. So it's your responsibility to get that security agreement recorded in the county in which it's located. Now, you can do that yourself on a mail away, call the county, et cetera, set it up, or you can have your third-party servicer do that for you. Okay, but you have to tell them to do it. So either way, the responsibility is yours to get it recorded. Whether you do it or your third-party servicing company is up to you.
Yeah, and that falls under the old trust but verify. That is a big issue. I'll give you just a quick story. About 10 or 12 years ago, a really good friend of mine, and this would have been like 2009 maybe, I got a call from a good buddy of mine. And he said, hey, listen, my mom has an account with someone that I think is kind of what you do. And obviously, You know, I was a 20 something and not a whole lot of 20 somethings know about self-directed IRAs and accounts. And so I said, well, you know, yeah, I'll talk to your mom. And so I talked to her and she said, yeah, I loaned money out of my IRA to someone. And I thought, okay, yeah, you're probably, you know, in a self-directed account. And so as I went through it, long story short, she wrote a loan to an investor. That investor took the loan, told her it was a secured loan, gave her all the documents, right, but never reported anything. Then took that same property, went to a financial institution, big bank, and said, I need to borrow money against this property. That property, the title company did a search. There was nothing recorded that would suggest there's any liens on the property. And so you had now, you know, a very mom and pop's investor, literally, that was having to figure out if she wanted to file some sort of legal, you know, activity against a big bank. And it was all because she trusted but didn't verify. In 5 seconds, you can log on to the county appraiser's website and see that it's recorded. And if it's not there, when people are doing lien searches on these properties, nothing's going to show up. They don't know that two people in a back room signed a note and a mortgage on a property. And it's not the bank's fault, right? And good luck, you know, trying to peel that first lien position away from a bank in a scenario like that. So thankfully, they were able to resolve it to some degree, but it was a very expensive deal, and she ended up losing, you know, not all of her money, but a decent amount of money on it. The second piece of trust but verify that we see happen a lot is if you're doing longer loans, right, where you're right, is, you know, especially if you're buying existing notes or confirm that the property taxes and the insurance are paid. We run into issues with this all the time. We've had properties burned down and there's no insurance on the property. And there was, when they wrote the loan, there was a 12-month policy, right? Or they bought an existing loan or a non-performing note, and they never put insurance on the property and they never validated that. The property burned down and there's no insurance. And we've seen the same thing where properties have gone all the way through the process, you know, to potentially be sold a tax deed because property taxes haven't been paid. So, you know, all those items under that trust but verify, you can rely on third parties to take responsibility, but at the end of the day, no one is going to ensure that your money is as safe and secure as you will. Spend the 5 minutes on the internet once a year and validate that your mortgage is recorded, validate that your property taxes are being paid unless you're escrowing somehow for that or your service agent is, and make sure you're getting proof of insurance on an annual basis.
Right, and that falls under what I would call my due diligence checklist, you know, and you're right, before you buy an investment, you have to look at those items, you know, yep. You got it.
Last question that I see and I want to kind of just put out on the table for you is obviously, you know, that you don't have a crystal ball. At least I don't think you do. And if you did, you're probably like me and way too scared to actually look into it. But if you were going to look out at the next, we'll call it 6 months, if you're going to look at kind of the rest of 2020 as an investor, is there particular types of notes you would be looking at? Are there particular things or clauses in your agreements that you'd want to ensure were there? What would be any of the recommendations you would have on ways to help protect yourself in what I think we would all agree is an uncertain market?
Correct. Yes, the uncertainty throws a new wrinkle in everything that at every level, no matter what you're investing in, because it's affecting the overall economy. So, you know, there's a lot of things at play here. In the note space, again, I think what you're going to see within 2 months is a big adjustment on prices. And so I think notes will be devalued, which again opens up a bit of a buying opportunity. And then you got to keep a really good eye on what property values start to do as well. You know, so it's a combination of those two things. If property values seem to maintain a little bit and the note price goes down, that's a good scenario. If the prices go down on notes and the property values kind of go down as well, it's still a good scenario because we have this buffer in between. If we see note prices stay the same and property values going down, now you're getting a thinner margin here. So those are the keys that you would look at in this. But I think in 6 months, it's going to be a whole different world because again, the big companies can't handle that. And the way they do things, I don't want to get too deep into this. There were 4 real estate investment trusts that specializes in mortgages that are missing their margin calls right now. because what they did was they pledged their portfolio as collateral and borrowed money. And now the notes are looking already, the bank said, well, the notes aren't worth that anymore because we know there's going to be a default rate, and they made margin calls. That's putting yourself in the wrong type of leverage. I wouldn't do, obviously anything like that. That's what the bigger companies are doing. What that causes then is those companies are going to have to sell assets, and they're going to have to dump them. They're going to already take a hit because the penalty, if you will, of the not making margin calls is greater than taking a loss on their investments. So I think we're going to see another wave. That's that fourth wave of inventory as a result of that.
Well, Kevin, I want to thank you for taking the time today. I've seen you speak many, many times, and I always get an extra nugget or two every time. So I want to thank you for that. And thank you for being here. Sorry that we had to move this online, but I think we're all getting acclimated and accustomed to that. At this point, I want to thank everybody that took the time today and came on, to today's event. Again, we're sorry that we had to transition it, but like many businesses right now, we're all taking it day by day. NuView is still fully open and operational. We are an essential service, so regardless of what happens around us, our team has been briefed on, protocols and things to ensure that clients always have access to their money, whether it be for investments or distributions. We'll be here to serve you. So thank you guys all very much for joining us, and everybody take care.